You won't believe what just happened to the U.S. mortgage market. Worse than 2008? The U.S. housing crisis has gotten worse. Mortgage applications are crashing through the gate by 41% over the year and are now at their lowest. This means that this year's housing market will most likely be a dump. In this video, we will extensively talk about the crisis in the U.S. mortgage market, so stay tuned. Before you continue forward, I would request that you subscribe to our channel. Thank you. So, what does this crisis mean? This means that real estate agents are likely to come across more open houses and people who are willing to sell their houses at a cheaper price. This we know for sure because, in January alone, only 29% of real estate purchases were made with cash. This means that more than 70% of people needed financing, or in other words, needed a mortgage. The demand for mortgages has become a huge problem for the U.S. housing market, and the excessive dependence on it may be more than what it was in 2008. This means that as the prices of inventory goes up, active buyers will drop, and that will put pressure back on the seller. This will inevitably result in prices declining in the real estate market. We are already seeing mortgage rates drop by a little amount. But now that mortgage rates have risen to 6.6%, depending on the market, they could go up to 6.9%. The housing market has come down a little, but the average price of a house is still beyond the means of what a median income can afford, and we can be sure that the regular home buyer is priced out of the market. So when can the average buyer start to buy then? Well, things will not start looking up for the average median income household until both the home prices and the mortgage prices start coming down. This will also help bring down the average house payments per month in the US, which is now around $2.5K. This price is double what new homeowners were used to back in 2020 and double what the average home buyer was paying before the market crash in 2008. Realtors in the corporate sector speculate that the house payment line will not go down because the inventory is pretty low in the U.S. housing market, and so the prices will likely stay the way they are. The U.S. Census Bureau actually substantiated this claim. In 2022, there were only about 720,000 houses available for sale. But there are statistics which point to a different picture. According to these statistics, there are about 40 million vacant houses which have not been released in the market as of yet. And if only 5% of those vacant houses were to be released by investors in the real estate market, then the inventory wouldn't be short anymore. Besides, not every state is running short. For example, Utah does not have this problem, and inventory is up by 150% in Arizona. In Idaho, it's up by 150% too, and in Washington, it's up by 140%, and in North Carolina, it's up by 100%. In North Carolina, we are starting to see inventory climb in cities like Charlotte, Raleigh, Greensboro, and Winston-Salem. Now let's take a look at some other statistics. We are seeing a sharp decline in buyer demand too. In Charlotte, the demand is at minus 54%. States like Florida and Arkansas are struggling to find home buyers. The markets are already crashing in cities like San Jose, Austin, Las Vegas, and Phoenix, where demand is down by 50%. This means that buyers are not simply waiting for the house prices to go down. Now, this is the time to have that necessary talk about the market recession which everybody said would happen in 2022. But we will need some historical records to actually substantiate what we will be talking about. Look at the market highs and lows. We can see that after every market peak, we see a market recession. For instance, in the peak we see from 1980 to 1982, we immediately had a market decline in 1990 to 91 during the Gulf War. This indicates a recession is officially around the corner or that we may have just entered one. This may actually jolt the economy in the middle of 2023, and this recession will make the market dynamics even worse and will suppress buyer demand. So what does all this mean? This means that while the inventory will go up, the prices will go down, and this will cause foreclosures. Right now, the foreclosure rate is at an all-time low. But in a recession, foreclosures will increase since there is a big increase in the delinquency rate on FHA loans. The 30-day delinquency rate has actually increased to about 5.6%. This could easily translate into 60 and 90-day delinquencies, which would result in foreclosure filings. For someone who is either trying to buy a home or invest in real estate, what does this mean? This means that it does not make much sense to buy a home, and in fact, it makes more sense to rent. For instance, in LA right now, mortgage payments cost on average $5,000, but in terms of rent, you can expect to pay around $3,000. Buyers look at the average mortgage rates, and they realize that it does not make much sense to buy, regardless of what Wall Street is saying. Now let's see where inventory has gone up and how much these markets are going to hurt because of this mortgage collapse. For instance, in Nashville, the real estate inventory has gone up by 300%. This means that buying is not a good option right now. Let's take a look at Dallas. Inventory has increased by 200%, and it is bound to increase further. The housing market is not going to recover anytime soon, and the same is going to happen in Riverside, California. In Riverside, inventory has gone up by 124%. This place is not being swarmed by house buyers. At the very same time, there are places in the Northeast, such as New York, Syracuse, Chicago, and Hartford, but the inventory is still pretty low. Buyer demand is also looking very good in the same areas. In fact, the buyer demand is the best as compared to all other areas in the US. In some of these areas, buyers are still buying at a 6.5% mortgage rate, and we are seeing a migration shift in these specific areas in the US. From this, we can say that more people are moving to Syracuse, where the inventory is low, than, for example, to Tampa, where the inventory has gone up by 200%. Overall, we can say that the housing market in these areas will do much better than the housing market elsewhere. Again, this does not mean that you should heavily invest in Northeast, since the mortgage payments in Boston are around $4,000 along with insurance and taxes, yet you can rent a comparable property for around $2,900 per month. With that, we will sign off from this video. Please like and share this video and subscribe to our channel. Thank you.